Hello once again and welcome to the third section of this course. In the previous section, we studied the trading psychology of professional traders and how they will become your new investment partners once you start thinking and trading like them. Many people think currency trading is only for the wealthy. That's not true. What is true is that there is no other market that offers the potential to create great wealth in a relatively short period of time, such as the currency markets offer. With the right guidance and following the right crowd, you can trade these markets very effectively with a modest account of 10,000 US dollars or sometimes less. Continuing from where we left in the previous section, we look forward to understanding the sentiment of professional traders, which is reason behind every price change on any trading instrument, whether it be forex, stocks or commodities. Market sentiment at its core is defined as a general thought, feeling, or sense of traders towards a financial instrument. Since our interest is in aligning ourselves with the professionals, it is therefore their sentiment or emotion towards a financial instrument that we are most interested in. While most market followers look at charts, you will be looking at the actual condition that affects price change. Every time professionals sense an opportunity in the markets, they step up and buy in millions. And they leave traces of their trading activity, which as a retail trader we must capitalize on. They are not speculating guys, they have the ability to start new trends in the forex, such is their power. After all, they contribute to more than 60% of the trading activity per day within forex. This brings me to reveal a little secret about why I've decided to choose Elliott waves, price action and volumes to trade markets over the years. All three of these leading technical indicators reveal the underlying market sentiment in one way or the other. Elliott waves reveal the change in market sentiment linked to wave terminations, hence signaling trade opportunities. A wave termination, as you will later study, is a point where a shift in market sentiment occurs. Price action reveals the change in market sentiment through various strong price action formations and patterns, which you will study later. You will also study how price candles within a candlestick chart reveal so much more than the open, high, low and close within a candle. And finally, one of the best discoveries I made as a part of my trading was figuring out how to use volumes in my trading. Volumes confirm the validity of change in sentiment reflected within Elliott waves and price action. I'm sure that this has convinced you why I've traded using these powerful technical indicators. These indicators will become your best buddies by the end of this complete course. While professional traders leave traces of their trading activity and reveal the underlying market sentiment, a retail trader must capitalize on these traces by speculating the future market direction on any trading entity. It is our job to buy low and sell high by following the footsteps of these large investors. This brings me to introduce two types of market sentiments that prevail: bullish market sentiment and bearish market sentiment. A bullish market sentiment presents a buying opportunity as the selling weakens, signaling a possible reversal, and this is portrayed within market price bottom where professionals are looking to buy in large amounts. On the other side, a bearish market sentiment starts when a market top is formed and sellers take control of the market, and this is where professionals are looking to sell in large amounts. And these market extremes are the areas where the money is. Success in trading is all about buying and selling at the right price and right time, and these sentiment extremes serve that purpose for us guys. Let's look at a basic example of bullish market extreme and bearish market extreme within a forex pair. Now, to understand change in underlying sentiment in forex during a major news release, let's look at this flowchart. Firstly, traders around the world react on the news, which triggers quick fluctuations in price. Secondly, economists react to the fundamentals related to the news. Next, announcements from central banks are reflected in the price. And after all this drama, the final market trend is still defined by the underlying sentiment. This is when the closing price of a candle after major news becomes very important. And by now we know that larger the time frame, truer the picture a candle represents. Market sentiment explains why trading is much more than simple buying and selling of a currency pair. There are emotions behind every move. Majority of retail traders start speculating before the news release. They love this kind of trading because they love instant excitement. This is when they're most active. As we studied in the previous chapter, they're always looking to make quick gains and get out of the markets. More often than not, price is paid for that excitement in the form of a losing trade. On the other hand, a professional trader is always taking an intelligent perspective. Their goal is to capitalize on the liquidity provided by the retail traders. They're looking to enter the markets once the closing price confirms the change or continuity of the existing sentiment. So as a retail trader who wants to succeed in the long run, I want you to ask yourself a simple question next time you gamble your hard-earned money during a news release. Trading is difficult enough, so why subject yourself to an increased risk of failure? Before I conclude this section, I want to introduce you to one of the greatest speculators trading industry has seen. When it comes to trading classes, a book called Reminiscences of a Stock Operator is one of the top favorites among traders. It is based on the life of iconic trader Jesse Livermore, who made a fortune in early 19th century by speculating. And if you read that book, you will know why study of market sentiment is so important in trading. In the next 2 slides, I will present a text from the book and its translation which changed my trading. Please go through it carefully. Now that we have covered why speculation based on market sentiment has worked in the past, still works in present markets, and will continue working in trading business in far future, this brings an end to section 3 of this course and also to the foundation of the course. I'm confident that what you have studied in section 2 and 3 of this course will guide you in the right direction before you even choose your trading style based on technical analysis of your own choice. My goal was to introduce you to how not to trade, what mistakes not to make, and how not to think like an average trader and trade markets thinking that this could be your lucky day. Instead, what I really expect you guys to do is think like an investor and not a small term trader, because with so much manipulation, a small term trader will face consequences of taking large risks in their trading. Educate yourself correctly so that you stand out from the rest of the crowd and emulate the winners and not the herd which is failing to understand the dynamics of the market. And above all, respect your hard-earned money and it will give back the respect you deserve. And finally, guys, a gentle reminder, please go and leave your honest ratings and reviews for this course, as it is extremely important for new students to see what you think about this course. Thank you, and I will see you in the next section.